Hey guys.
Hi.
Hello.
Minutes late, my Zoom had to update, yay. So today we're going to talk about residential purchase agreement. And I think I'm going to wait a couple more minutes here. Anything interesting going on this week?
Nothing too exciting.
No. Hi Nagar. Hi Sharon.
Hi,
Hi
Kristen.
all of you. How are you?
Good, thank you. How are you?
You're welcome. While we wait, I'm going to pull up an RPA.
Hello, Kristen and everyone. So happy to be here.
So happy that you're here.
I can't wait. I'm so excited for this class today.
Why do you need to write an RPA?
Yes. As a matter of fact, you're 100% correct. Sorry, please don't mind me.
What's
having
that?
my food. I'm excited. I can't wait to go over it one more time and hopefully send something out. Very excited.
All right.
Thank you.
You're welcome. RPA is my favorite class. Let's see here.
These days, maybe the most important.
Yeah, it's pretty important. Sorry, this is taking so long, guys. I was having this problem earlier when I was trying to download an RPA because it Forms is not loading for me. Let's see if I can pull maybe an offer out of my email. We can look at it that way. Here. Oh. Anyone else having problems with zip forms today?
Didn't try them. Don't know.
Give me a second. I'm signing into my email. I kind of miss the days when we wrote these by hand and faxed them. Sorry, guys. I think it's because my computer is updating. That's why everything's slow. We're done now, so there's the offer. Great. Okay, I'm going to share it on my screen now. I think. There we go. All right. So every contract in real estate is going to have some disclosures attached to it, including the disclosure regarding agency relationship. This will be auto-populated. So this basically identifies, your relationship, your agency relationship with your client, what the seller's agent's responsibilities, buyer's agent's responsibilities, someone providing dual representation, buyer and seller responsibilities. I'm not going to review it, but I do recommend that you read it. A newer document that came out in October of 2020, the Fair Housing and Discrimination Advisory. Again, this is going to auto-populate. I'm not going to go through that. Another document that's going to always auto-populate, the PRBS, possible representation of more than one buyer or seller, disclosure and consent. Again, going to auto-populate wire fraud and electronic funds transfer advisory. I will briefly review this one because when clients sign an offer package, I oftentimes have questions about this because when they see the word fraud, it's a little scary. So what has been happening is somehow people committing fraud have been finding when offers are property, posing as the escrow company, sending fraudulent wire instructions to the buyer somehow. Once those funds are sent to the wrong place, they're almost impossible to recover. Escrow company actually send wire instructions via an encrypted email, and you should always verify them with your client. All right, so here we are with the RPA. Top left corner, date prepared. This is a legal identification date for the residential purchase agreement. So this date is not the day of signing. It's not the day of acceptance. This is literally the date that you prepared the offer. So it won't always be the same date as the date your client signed. This date's going to be important if you enter escrow because subsequent documentation is going to refer to this residential purchase agreement and it will ask for the date prepared. Okay. 1A, this is an offer from. This is where you enter your buyer's names. So if you have more than one buyer is going to be on here. If you are making an offer in the name of an entity, that's fine. Entities like an LLC, a corporation, a trust. There are loan implications with making an offer in the name of a trust. So if the buyer is obtaining a loan, or not just a trust, an entity, sorry. So if the buyer is making the purchase with the loan, you'll want to check with their lender to make sure that that's okay. Also here for buyers, particularly married couples, I see a lot of errors. So let's say it's a husband and wife and their names are John Smith and Jane Smith. If that is the case, you'll have two separate lines and you'll need to enter both their full names. There's no John and Jane Smith, no Mr. and Mrs. John Smith, no Mr. and Mrs. Smith. It needs to be everyone's full names here. And don't always assume that husband and wife share the last name. We know that that is often not the case. And so I often get questions, particularly from the wife. They will tell me, they have not changed their name. Is that okay? Whatever their legal name is should go on here. Sometimes they've legally changed their name, but they don't have the driver's license or ID card to back that up. That's going to be a problem for notaries. So that's a conversation you can have with the buyer if they've changed their name, but they don't have valid identification showing that name change. So just a conversation to have. If you see, if you know there's a recent marriage or you see hyphenation or anything like that, you'll want to make sure to ask whoever has that going on with their name if they have current valid ID to verify that, because later they'll need notarizations. The real property to be acquired is, and this is the property address. Guys, it's really important that we get the property address right. In the city of Los Angeles, there are so many areas. In fact, the areas are so well known, we oftentimes think that that is the city. The different cities have different transfer requirements in order to close an escrow, including retrofitting, building reports, different types of taxes, things like that. So I want to make sure you get the legal city. And what I mean by that is like Venice, Sherman Oaks, Hollywood, these are all city of Los Angeles. So I shouldn't have Sherman Oaks in here. I should have Los Angeles technically. Where can we get the legal city address?
Title.
Title, public record, legal investing. These can all be obtained through title or title software. If you're ever in doubt as to whether something is an area or a city, if you read the legal description, it goes something like this. It'll be like lot and a number. Lot 1 in tract 1, 2, 3, 4, block 5, located in the city of blank, county of blank. All right. So that's a legal description. So that's a way to find it also. I see chat. So yeah, title has software that you can log into and get that from. Very important, guys, this assessor parcel number, also referred to as APN. This is actually a stronger way of identification legally for a property address than its actual addresses. And the agent that made this offer didn't put the dashes in here, but in at least Los Angeles County, if it's a property in Los Angeles County, it will always be in a 4-digit - 3-digit - 3-digit format. It will be in a, if you see a different format, either they're missing something, they've made it an error, or it's not Los Angeles County. All right, the purchase price. Guys, who determines what offer price it is?
The buyer.
The buyer.
Yes. Yay, I didn't get any seller responses today.
Yay.
Good job, guys. All
I
right.
said seller, but I was on mute.
What's that? Oh, you were on mute? Yeah. Sellers wish they determined the offer price. We would probably make a lot more money, but there'd probably be a lot fewer sales. So yeah, the buyer is going to determine what this price is, and we know that they're not always realistic. It takes a few losses sometimes to get them to a place where their offer can get accepted, where they come up, they're comfortable coming up. D, close of escrow. So there's two options here. One is the first one, shall occur on blank. This is a finite date. So if you're writing an offer, this would be like, I'm going to close, we want to close on March 30th. I don't advise using this method. I much prefer and think it is safer to use the second option, or blank days after acceptance. The reason for this is because we have no control over how long the offer and possible subsequent counter offer process is going to take. So if there are multiple rounds of counter offers and it takes a week and a half, 2 weeks to come to an agreement and get the offer accepted, you now have 2 weeks less to close. Whereas if you used a time frame from the date of acceptance, you would have your full 30 days. And that's important because it's going to take you some time to do inspections. It's also going to take the lender a lot of time if there's a lot of buyers purchasing with a loan, to get that formal loan approval, get the appraisal ordered, all of that. So guys, what are the most common time frames for Section D?
30 days.
30 to 45.
Mhm.
Can it be fewer? Can it be more? Absolutely. More is considered less attractive by a seller. Fewer, if the buyer has a loan, might be a problem. You'll have to check with their lender to do any fewer than 30. If it's a cash purchase, it'd be tough to do it in under 10 to 14 days. And this is because it doesn't really matter how fast title, escrow, buyer, and seller are. The city of Los Angeles has some requirements. I had mentioned that building report previously. So it really depends on how well the the listing agent is set up. Do they have a prelim? Did they order the building report? Did they get the retrofitting certification? That reminds me, I need to do that actually on this property. If they have all of that stuff ready to go, you might be able to do it, in fewer days, 7 to 10, if you have an all cash offer. All right, 2, agency disclosure. We talked about the agency disclosure. That was the first document in this package. So this box will always be checked automatically. You don't have to check it yourself. Confirmation. So in this section, you're going to list the listing agent's brokerage. The brokerage's DRE number. indicate whether they represent the seller or buyer and seller. And you're going to do the same for yourself. You're going to be the seller's agent if you're the one writing the offer with your DRE. With your brokerage name and DRE, and then your name and DRE. I'm a little turned around because I'm using an offer on one of my listings versus an offer I wrote. So guys, I wanted to just talk to you about dual agency. So dual agency is if there are any agents from the same brokerage. It doesn't have to be the same sales agent. So Nagar, if you had a listing and I wrote on it, we are providing dual agency. Okay, so there's a difference between sales agent and brokerage. Also, I hear a lot of people going around using the term broker very erroneously.
And what about if it's Keller Williams downtown as opposed to Keller Williams Beverly Hills, each one representing one side?
So technically, anyone under the forward living blanket might be considered dual agency, but it's still a separate office with a separate broker. So we are not dual agency writing with a different Keller Williams office. You can check that you're representing just the party you're representing. Give me 1 second, guys. All right, let's see what else we have here. See, potentially competing buyers and sellers. We talked about that disclosure.
Oh, I'm so sorry. Before we go on, I did have one question.
Yes.
I was having an issue where it says, for example, seller's brokerage firm. Sometimes there's like two agents, either from the same office or different offices. But when you try to input the license number, there's not enough space to allow it. So how do you do that in a clean,
I do it by, on the same line, I put the / right after the first DRE, no spaces, I put the second DRE number. It should fit. And even if it doesn't, it will populate entirely where it's readable elsewhere in the contract. So I do not split. Anytime there's two agents, even if I'm representing the buyer and I have a co-buyer rep agent, I put them on the same line. And the reason for that is because otherwise the signature lines get messed up.
Okay, so even if it doesn't show, then it will auto-populate.
It will auto-populate the full number further down in the contract, somewhere where there's more space, I think on page 10. So yeah, just enter it in.
Thank you. Sorry.
You're fine. Oh, so we were talking about dual agency and the term broker. So most of you are not a broker. It's possible that someone on this call is, but highly unlikely. To be a broker, you have to go take a secondary test. So anyone who's calling themselves a broker has either done this or doesn't know what they're talking about, and it's more common than you'd think. So they've already taken, they've either taken a second test after 2 years of full-time real estate experience, or they went to college, got a degree in real estate, and that's the only way to circumvent that 2-year requirement. Okay, let's see here. Finance terms, initial deposit. Guys, can anyone tell me what percentage of the sales price is customary, is standard for the initial money, initial deposit, also referred to as earnest money deposit?
3%.
Yes. Can you do more or less?
Yes.
Yeah. If you do less, your
It makes it
offer
look weak.
Yeah, the offer looks weak. If you do more, that's fine. But whatever amount is the earnest money deposit is what would potentially be up for grabs to the seller if the buyer were to move forward, lift all their contingencies, and fail to close the transaction. Okay. So there is something very special about the initial deposit or earnest money deposit. There is a contingency time frame written into our contract boilerplate language of 3 days. But unlike every other time frame in our contract, this is based on business days. Every other contingency, the way it's written, unless it's modified in our contract, is based on calendar days. So any idea why this would be? Business days versus calendar days.
Because if there's a
Because
holiday and someone tries to go into escrow on Friday, it might not the money might not go in until Monday, or
And why is that? Is because the
because
banks might
banks
be
aren't
closed.
always open on
Yeah.
the weekends or on holidays.
Right, yeah, so the banks have to be open, so 3 business days, it's a very special contingency. So if I go into escrow on a regular Friday, not a holiday weekend, when is the buyer's deposit due? If I get acceptance on a Friday, Saturday doesn't count, Sunday doesn't count, but Monday, Tuesday, Wednesday counts. So Wednesday is the due date. If I go into escrow on Thursday, Friday counts, Monday, Tuesday counts. Okay. Let's see here. So also the initial deposit, you'll see that the agent who wrote this contract said other bank wire. That's not necessary. The way that our contract is written is that the deposit is going to go by electronic funds transferred directly to escrow. Okay. Can you deliver a deposit any other way to escrow? Our contract's very misleading. No, we cannot. Escrow companies do not accept cashier's checks anymore, and they have not accepted personal checks in at least 20 years. And they don't accept cash. I've had that happen. The buyer tries to take a suitcase full of cash into escrow, and I'm like, what are you doing? Who are you? What's your job again? All right, increased deposit. So this section is not commonly used, although because our market is so competitive, it is, I'm seeing it more and more often. An increased deposit is an additional deposit that might be delivered a certain time frame or upon a certain action occurring within an escrow. And the purpose of using this might be just to make the buyer's offer stand out, look more attractive. Hey, 10 days after escrow, the buyer will deposit an additional $50,000, whatever they want to offer. Or I don't actually like the way this is written, that a certain period of time after acceptance, the deposit should be due. I like to say it uses other section and say, or within 2 business days of the buyer lifting their physical inspection contingency is usually the way I like to do it if I'm offering an increased deposit. Now, though we use this section, generally speaking, to make an offer more attractive, it can also be used to bait a seller into providing a longer escrow period that they might not otherwise consider. But an increased deposit may or may not carry much weight, and it may or may not be perceived to have weight, whether or not it does. Sorry to be so confusing, by the listing agent. And I'll explain that a little further, is that unlike the earnest money deposit, which is automatically available for the seller to try to go after in the case that a buyer lifts their contingencies and fails to close, an increased deposit isn't necessarily. The only way it would be available is if the buyer's agent provides car form RID. Okay, so if you're receiving an offer as a listing agent that has an increased deposit, but there's no RID, car form RID, you need to ask for it, because this increased deposit is basically smoke and mirrors. Do they have to put it in escrow? Yes, but can the seller ever go after it? No. So it's really not, shouldn't be much of an incentive to the seller. Now, as the buyer's agent, when I offer an increased deposit, I always try to get away with not providing RID. I would love to make my buyer's offer look stronger to the untrained listing agent, while at the same time not actually putting more of my buyer's money at risk. But if I get caught, do I give them RID? Absolutely. Oops, sorry, I forgot. I'll get that right over to you. All cash offer. I wish all of my offers were all cash offers. It makes everything a whole lot easier. If you check this box, you will not be able to fill out anything in section D, and you don't need to. Okay. So an all cash offer, you'll notice that it says verification of funds to close this transaction is attached to this offer. That means if you're writing an all cash offer, that verification of funds needs to be attached. Guys, you guys should never be sending out an offer without verification of funds for the entire down payment and closing costs for the buyer. Why? That offer is worthless. Why would we accept an offer where we don't have proof that the buyer has the financial ability to put up the funds they're telling us they're going to put up in the contractual terms we have under the finance section? Okay. So if you're writing an all cash offer and you're saying that the buyer is going to deliver that verification after acceptance, your offer is pretty worthless. Section D, much more common that a buyer is purchasing a property with a loan. Can anyone tell me what the most standard loan to percentage of purchase price down is
20%.
standard? What's that?
20%.
20% down, 80% loan is the most common. Can it be different? Absolutely. Absolutely. We have 90-10 loans. We have 95-5 loans. In this instance, the accepted offer price is $1 million. I think they wrote this offer at $975, but they're offering to put $475 down, right? So loan amount can be pretty much anything. I do want you guys to be wary of anything below 10% down total. Okay, so anything over a 90% loan, be aware of that. That's a very problematic loan. Oftentimes impossible to obtain, but not 100% of the time impossible. If you're a listing agent, you definitely give, a lot more weight to what kind of percentage the buyer is putting down. And what I mean by that is if you have a buyer that's saying they're going to get a 95% loan, that's a way trickier loan. It's less likely to get approval and close. So if I have 3 like offers and one of them has 20% down and the other 2 have 10 or fewer percent down, I'm definitely calling all of the lenders. I'm still probably countering everyone, but I'm probably asking for that higher deposit amount because that's a risky loan, 90-10 or 95-5. I just saw something in my email today, and I don't know if it's true or not, but I saw some evidence that someone just closed a 0% down loan, 100% financing. I would be surprised if that was happening, but be particularly wary of that. All right, so the first loan amount, whatever it is going to go in here. You do need to fill out this section, rate not to exceed. Where should you get this information?
From the
loan
lender.
officer?
Yeah,
Lender.
from the mortgage broker or lender. Do we know the difference between a mortgage broker and a lender? Okay, so first off, lenders are like if the client goes to the bank or credit union directly. And not always, but usually you're going to have a harder time with this loan officer performing. It's usually going to take longer. Why? It's an institution. There's a lot of bureaucracy. Also, this is not as common because banks, they can only shop their own programs. So most of the time, the buyer is not going to find the best rate here. Okay. Mortgage broker is a lot more common, and a mortgage broker is exactly what it sounds like. They're a broker that can shop all sorts of different loan programs. They are, they have a lot more incentive to
Hello,
perform.
this is George.
George, mute you. Thank you. So I'm not saying, your buyer can't buy with a bank or a lender direct, but again, you just need to watch out for that. The timeframes you're going to write into your contract might be a little bit different. A mortgage broker, they can be just as bad, but generally speaking, they have a higher level of performance. So you're going to ask them what this number is. And the reason this number is important is because there's a loan contingency. And one of the terms of that contingency, which is, a get out of jail free card, a cancellation, that the contract protects the buyer for the reason of, is that, you know, they can qualify maybe for a loan, but it's higher than this rate. Well, the buyer can still cancel. Okay. And the reason for that is because we don't want to bind, legally bind the buyer into having to accept a loan with a rate of 7, 8, 9, 10%, because that might dramatically affect their ability to afford the mortgage. So very important that we put a number in here and get that from the loan professional.
Kristen, in
Yes.
your business, do you prefer working with brokers over lenders?
100%.
Gotcha.
Yeah. A bank doesn't care. They just do stuff when they do it. You have to hound them as the agent. Let me tell you, as almost always the most problematic party in any transaction is the buyer's lender. A whole lot of babysitting and stress and reminding them of your deadlines and timeframes. So I always try to heavily influence my buyers into using my preferred mortgage broker.
And Kristen, I also heard that since in the last couple of weeks, the rates have gone up about 0.5%.
They have.
And they don't allow you to lock anything unless you have submitted an offer and gotten an acceptance. Is that correct?
Yeah, you can't lock a rate unless you have an accepted offer.
So we're already half a percentage, unfortunately to our disadvantage as the buyers, just in the last 10 days, half
Yes.
a percent is a lot of
Yes.
money.
Yes. Yeah, it is. It's still really low interest rate though. It's still really low. It's just not low as low as it has been. All right, so second loan, guys. A second loan is exactly what it sounds like. The buyer's just purchasing the property with 2 instead of 1 loan. You'd fill out second loan the same way you'd fill out the first loan, but only if the buyer's mortgage broker or lender indicated that that's the way it needs to be done. As a listing agent, again, I want to caution you to be very wary when you see offers written this way. There are some, not necessarily reasons of eligibility or, the ability of the buyer to obtain a loan, but sometimes it is. If they can't get qualified for the first, there's usually a weird reason. The only time I've done a transaction with a second loan in the last year, the buyer had, a special kind of visa. They weren't fully a citizen yet. And so we had to shop certain programs, like we could only get a certain amount of money. There are weird guidelines and regulations with banks in order to obtain loans. So just be wary that it might be a little bit harder, might be a little trickier, might be a little less solid. FHA or yes.
That's what I'm about to ask you right now. What about those offers that is FHA or VA that, is very low down payment? How we can make the offer more attractive, even though that is harder in this market, but how we can make it more attractive?
Well, you're probably going to have to offer more money on the purchase price. You generally pay to play with these loan types. Why? Because most listing agents do not understand them. Now, these types of loans, these loans are actually, in my opinion, some of the most solid pre-qualifications that there are out there, but most listing agents do not know this. So you definitely want to educate the listing agent when you present an offer with this type of loan because of the lower down payment. FHA, once a buyer is in there, approved, there's some, both of these, the seller pays for some fees they wouldn't typically pay for. So again, you're just going to pay to play, offer a little bit higher price. VA loans oftentimes take forever to get approval and appraisal and everything through. It's because, it's a government run program. But again, they might take a little longer. There might be a couple of extra hoops, but the initial application process for these types of loans is much more stringent than the normal loan. So I do feel like these buyers' approval is very strong. It's just how many hoops and how many hoops do we have to jump through and how much longer will it take than a standard loan purchase? if you have never done FHA or VA, it's going to be a lot different. That buyer's lender or mortgage broker is going to become your best friend, and I hope they're good at their job. Additional financing terms. Okay, so this can be used for quite a few things. Oh, you know what? There was something else up here. Oh no, it's not here anymore. Okay, additional financing terms. So I use section E most often for when I have a buyer who has the ability to purchase cash, but would like to explore the option of obtaining a loan. This is very common with developer clients and high net worth individuals. So I want to write the offer as all cash because I want the strength of presenting it as all cash. And I'm still going to show a proof of funds for the entire purchase price. But under additional financing terms, locking the seller into cooperating with the buyer's loan process, but without providing the buyer contractual contingency protection, is what I'm doing here in section E if I am writing an all cash offer with the legal option for the buyer to obtain a loan. And I use very specific language for that. I'm going to get the chat box up so I can type it in here for you. It's buyer reserves the right to obtain contingency free financing at their sole discretion. Everybody see that in the chat box? Buyer reserves the right to obtain contingency-free financing at their sole discretion. Does this give the buyer any protection to obtain a loan? No, not at all. It simply gives them the right to obtain one. It simply binds the seller to cooperating with the buyer obtaining one. It binds escrow to cooperating with the buyer obtaining one. If the buyer is unable to obtain one, they are still bound to make the purchase cash. Okay, so it is just a way of showing the strength of a cash offer while reserving the right to obtain financing without any protections. Okay, let's see. Balance of down payment or purchase price. Okay, so this is often tricky for people. So remember, in the most common loan situation, there's 20% down and 80% loan. So balance of down payment or purchase price, what percentage of the purchase price is going to go in here if we have an 80-20?
17.
Yes, thank you. Why?
Because it's 20% minus the 3% deposit.
Yes, if you had a 5% deposit, how many percent would go in here?
15.
That's right. Perfect. You guys got this. Yay. Now, section G. Don't skip over it. I make typos in my financials, in my offers all the time. You need to make sure that section G matches your offer price. Okay, that's your fail safe. I put in extra zeros or one too few. I'm gonna make someone a very, very sad or very, very happy person on accident one day. Or make myself look really dumb to my buyer, which I've done. Okay, section H, verification of down payment and closing costs. So if you are making the offer with a loan, a contingent loan, as is normal, we have to indicate that the proof of funds or verification of closing cost of down payment. So verification of down payment and proof of funds are the same thing, guys. You would check this box because you've taken this class, you're a great agent, you're going to make me proud, and you're never ever going to submit an offer without proof of funds because that offer is worthless. I, appraisal, contingency, and removal. We're going to talk about I and J at the same time. Okay, so specifically the section J3. That's because these two contingencies, appraisal and loan, are connected to each other. You cannot get what, okay, so I'm going to give a little backstory here. Loan approval has many stages, and particularly crummy mortgage brokers and lenders will try to confuse you. Okay. There are different levels, like I said, of approval. So when a buyer first talks to a mortgage broker or a lender and they get that pre-qualification or pre-approval letter, that is called pre-approval. They've been approved for a loan, basically after a verbal conversation without any verification. Okay. So if there are no curveballs, if there's nothing strange, if every single piece of information, even the factors that a potential buyer doesn't know that they need to make a lender aware of, are exactly as the buyer has told the lender, shouldn't be a problem, is basically what pre-approval means. Okay, so pre-approval is not very solid. In fact, I think that it's silly that it's given so much weight as far as being presented with the offer, because it's really a verbal conversation between the lender and the buyer. Then there is conditional approval. And this would be like after acceptance, typically, not always, but almost always, after acceptance, after, a week or so, when the lender gets a whole bunch of information back from escrow. And at this time, the lender is going to do something called DU approval, direct underwriting. This is when they actually pull like hard credit report and all of that. Okay. So pre-approval doesn't require a hard credit inquiry, but initial approval or conditional approval does. Okay. So we have pre-approval, conditional approval. About halfway or more into the transaction, after the appraisal's done, come back and approved, and we'll talk more about appraisal in a second. Then the lender is going to submit for final approval to underwriting. And this may happen more than once, because when they submit the file to the underwriter, the underwriter's either going to approve it or ask for what are called conditions. If there are conditions, it's going to go back to the mortgage broker or loan officer. They're going to work with the buyer to get those and resubmit it to underwriting. Only after underwriting has said, you are 100% okay, we're ready to issue loan documents and a closing disclosure. That's formal loan approval. So remember, we can have conditional approval many times. And I have seen loan professionals say, we have approval. And I'm like, the fuck we do? You're confusing everyone. You're lying and you're buying time. Do not tell my buyer we have approval. We do not. My question is, and I've had loan professionals argue with me about this, and I'm like, okay, put it in writing that it is safe for me to lift the loan contingency. They won't do it. If they won't do it, you don't have formal loan approval. Okay, so that's your fail-safe check. It makes me very angry. Can you tell this recently happened to me again?
Thank you for sharing that, because that's a good point. Put it in writing.
Yeah. Yeah, I write the email. Do we have formal loan approval? Is it safe to remove the loan contingency? Unless that answer is yes, you don't have loan approval. Okay. Now I'm going to back up to appraisal. The appraisal process is different based on purchase price and different property type. But what will always remain the same is that the bank has an independent appraisal department. Why? They want to make sure no loan professional is influencing the decision of the appraiser. The only people who can have interaction with the appraiser are the agents. Okay. Whether you're the listing agent or the buyer's agent, I strongly recommend that you be there during the appraisal. Okay. If I think if I'm representing the buyer and the listing agent is very competent, I'm very confident in the purchase price, I won't be there. But if I'm pushing the envelope, which is very common right now because our market is so hot, we don't have a lot of inventory on the appraisal, I am going to be there. Why? I want to try to influence the appraiser's decision. I'm not supposed to, but I'm doing it factually, and so that's okay. They will take other factors into consideration. So if I'm worried about an appraisal, as a buyer's agent, I will probably go. Because there are a lot of listing agents out there that do not do half of their job. And I want my deal to close. So the things I'll mention to them is, oh, there were 15 offers on this property. You know, oh, this, that, oh, the one across the street, you know, if I happen to know what it's in escrow for, that it's going to close soon. Give the contact information of the listing agent on those properties that are in escrow that you happen to have, you know, asked for the contract price, so that the appraiser can contact them if you're worried about an appraisal price. Bring comps. Don't always just look at relevant comps either. I have influenced appraisers by pulling comps on smaller property. When I couldn't find comps that were very similar to my subject property, that helped support my purchase price, I pulled smaller ones that did support that higher purchase price, and I was able to push it through that way. So right now, particularly right now, it's going to be very important for you to make sure you get the appraiser's contact information, you meet them there, you bring comps, you email them comps, get their contact info, okay? You tell them anything that is special about that property or how competitive it was to get it. As a listing agent, even more important, that's a primary responsibility. Okay, so back to the appraisal process. I'm sorry, did someone have a question also? I thought I heard something. No? Okay.
No, I just wanted to see what we are supposed to tell the appraisal to, you know, affect his decision, and you answered that.
Oh, good.
Thank you.
Very good. Yeah, you're welcome. Okay, so because there's an independent appraisal review department, well, the process is the appraiser is hired by the bank. Then the appraiser contacts typically the listing agent. Sometimes they'll contact the buyer's agent erroneously. I actually tell my lender to have them contact me because I never trust that the listing agent is going to do their job correctly. So I would rather negotiate that appointment so that I know I can be there. Otherwise, they might contact the listing agent directly, make that appointment. That listing agent might have it on lockbox. I might not appraise. I want to have influence over that appraisal amount. So they're going to contact the listing agent or me. We're going to set the appointment. They're going to go physically to the property unless the value is so apparent that they can do it by drive-by. Okay. They're going to go into that property and they're going to do two things. They're going to assess the value and they're going to look sometimes at safety issues or permitting issues. Okay. Sometimes there are problematic appraisers that will cause issues for you. Sometimes there are team players that will not. Most typically, they're asking for things like carbon monoxide detectors, which in the city of LA, we're going to do with the retrofitting, but they might want it done before they'll give the appraisal, which is annoying, but you have to play ball and do it. Okay, so once they do that, if they haven't called out anything they're demanding you fix before they'll give you the report, they will submit that report to the lender and give it to the buyer. Does that mean that the appraisal is handled, that we can lift the contingency? Absolutely not. Once the appraisal comes back, it goes to a special, remember I told you there was a special department in the lender that is independent. It's called the Appraisal Underwriting Review Department or Appraisal Review Department. And that's so that no one can sway the opinion of the value. That typically takes 3 days. Once that happens, once the appraisal is reviewed by the independent review department within the lender, they will go back to the loan professional, the mortgage broker or loan officer, and say, appraisal approved or not approved. If they say approved, great. Then that approved appraisal can be submitted to the regular underwriting department, which can give the formal loan approval. So remember, I said I wanted to discuss these together because you cannot have a loan approval, a formal loan approval, without an appraisal approval. So the time frame for an appraisal is typically 14 to 17 days. Can you do it a little faster? Yes, but you better make sure that your buyer's loan professional is on board and all over that. Okay. So 7 to 14 days. Which means that the loan contingency should be at least 3 days after, right? Remember I told you a regular underwriting review department might take 2 to 3 days to review. So if we just get the appraisal approval back, it's going to take 2 to 3 days at a minimum to get the loan approval, because the regular underwriter is not going to review for formal approval until they have the completely approved appraisal. So if we have 14 to 17 days in section I, under J3, I want to see 17 to 21. Right now, lenders are backed up, and so a loan approval is typically taking 21 days. Pre-pandemic, I didn't like to see a number higher than 17 here to be considered competitive. Okay. Right now, also because of the appraisal issues, because of the lack of inventory, the most common thing I'm seeing in counter offers is that the seller wants the buyer to remove their appraisal contingency with the offer. This can be tricky. You should, I'm not going to go into it, but there are some workarounds for it. You can see those in my how to get your buyer offer accepted in multiple offers. Okay. How to get your buyer's offer accepted in multiples. I have that class. It is recorded. It is on YouTube. And it is particularly helpful for the environment we're in right now. There are some workarounds for it. Just please understand the relationship between appraisal and loan contingency. No loan contingency. Can you have no loan contingency if you have a loan? Come on, guys. Yeah, you can have no loan contingency protection if you have a loan. It is risky. You should only do this if the buyer is game and if their lender or mortgage broker tells you 100% that is safe. They're very confident. What does that typically mean? It means that buyer is so qualified, there's not going to be any issue getting them any loan with almost any lender. It generally means they're underbuying and they're just super qualified. That can make your offer look really attractive. But it's not safe to do unless the lender says it is.
I'm sorry, Kristen, I lost you for a moment, so I had to log back in. Did you say that as far as the appraisal, you leave it at the 17, or I'm sorry, I missed that. I just lost connection for a moment.
It's typically 14 to 17 days. Of course, those dates you need to make sure that your buyer's lender is okay with, right? It's typically 14 to 17. Can it be done sooner? Absolutely. But you need to make sure that the buyer's loan professional is really on board with getting it done sooner. It means they need to order the appraisal pretty much once escrow is opened to get it passed.
Okay, so but generally in this competitive sellers market today, you would keep it at 17 or?
I would try for 14. I always want things to be as short as possible because we are so competitive.
Okay,
you know, the only time I'm going to write something like 17 is, you know, maybe if property's been sitting on the market for 3 months, something like that. I can be a lot more, you know, lax or protective of my buyer.
Thank you.
5 is, even though we don't have to fill anything out here, is very important. Lender limits on buyer credits. Let's say your deal's going well, you have inspections, there's some problems, but negotiations went really well. Buyer and seller agree to a credit. So you draft up the paperwork, you send it in. First off, agents, escrow, and lender need that paperwork showing any kind of financial changes. But let's say I negotiated a credit for, you know, $25,000 on something. The lender might not allow the seller to credit the buyer that much. It's based on the buyer's closing costs. There are 2 types, recurring and non-recurring. Typically, the lender limits the credit amount to what the buyer's non-recurring closing costs are. The difference between recurring and non-recurring are one-time fees through closing versus things like property tax and insurance, which the buyer will continue to pay after close. Now, if you don't remember that or understand that, that is totally fine. All that you really need to remember is before you draft up paperwork for a buyer credit, you contact their lender and ask what is the maximum credit the buyer can receive. If your negotiated credit exceeds that dollar amount, you'll have to work with the mortgage broker or loan officer and adjust. You can do a credit still, you know, the maximum credit, but any overage you can adjust the
Purchase
the offer
price.
price, the purchase price, exactly. So you can do a combination, one or the other, but it's not up to us to decide that, it is up to the lender. And when either works, it is up to buyer and seller. Typically, a credit means a buyer has to come in with fewer funds at the close of escrow, whereas reduced purchase price typically has longer term but smaller effect benefits like lower property taxes for the duration of their ownership of that property. So, just check with the lender before you finalize any credits. That's all I need you to remember about that. Okay, buyer stated financing. We don't do that anymore. That's how the market crashed in 2007. Please don't do buyer stated financing. Anyone who tells you buyer stated financing, they're a liar. Maybe bank statement financing, but not buyer stated. Sale of buyer's property. Not very common right now. This is also, it's a confusing term, but referred to as a contingent offer. Why is it confusing? We have a bazillion contingencies in every escrow. But when someone refers to a contingent offer, what they're saying is that the buyer needs to sell a home or a property they own before they can make this purchase that they're making the offer on. And if they cannot sell and or close whatever it is they're selling, they are not legally obligated to complete this purchase. So that is a pretty weak offer, and considering our market is so competitive right now and there's so little inventory, we're not seeing much of this type of contingent offer. We may see it if the market flips. It'd be very common in a buyer's market. If you are writing a contingent offer, you have to check this box, and car form COP is going to auto-populate in zip forms. It is really confusing. I have a hard time filling it out. It takes me hours. I read it and reread it. And the reason for that is it's so complicated, and it has stipulations that modify the terms in our contract. So I have to keep on flipping back. I read this car form COP. I need to determine how to fill it out or check boxes, and I need to flip back to the purchase contract continuously to read it. So, and because it's not so common, it's not something I'm doing very often, really make sure that you spend the time understanding this form if you're going to use it, because an error in completion of this document can dramatically affect the escrow and the outcome of the purchase in a really significant detrimental way if it's not done correctly. Okay, addenda and advisories. Please do not do what this agent did. Buyer's inspection advisory is always attached to the offer, but I never want to see you guys attaching disclosures that are just part of the disclosure contingency. Okay, statewide buyer and seller advisory, particularly with KW agents. Somebody has been teaching agents to write offers with this attached. It is a long 14-page document. This other one, market conditions advisory. We don't want to attach anything to the contract that's not a contractual term. Why is that, guys? We're still going to do those documents during the course of escrow. We don't want them to be part of the offer because they're not commonly part of the offer. And so if escrow or any of the other entities in the transaction forward documents along that don't include these, which are not common, so they're often missed when they're forwarded along to another necessary party in the transaction, it could cause delays, particularly with the loan. So if it went to the underwriting department, the underwriter catches, oh, I should have this car form SBSA. You were expecting formal loan approval. Well, now it gets kicked back. You have this document signed. All you're doing it now is giving it to the lender because it wasn't submitted by either you or escrow initially properly. But it's going to go back to the bottom of the underwriting pile, and it's going to take 3 additional days. So don't attach anything to the offer that's not necessary. Okay, just don't. Some of the more common attachments to a contract are going to be an addendum. So if you need to address any terms with the offer or counter offers that you can't fit on the offer form or the counter offer form, you're going to have an addendum. If it is a short sale or a probate with court confirmation, you're gonna have an addendum. If it is a probate without court confirmation, you're not gonna have an addendum. You're going to have a probate purchase agreement. Okay, so probate, we have a special purchase agreement, court confirmation and non-court confirmation. Now, if you make the error and write the offer on a regular RPA, you might be able to check this box and do the court confirmation addendum, but it's not the right way. Probate purchase contract. Okay. If the property has a septic tank or a well, it needs to have an addendum. If you're writing for backup, which is very common now because our market is so competitive, or you're offered backup after your offer is not accepted and someone else's is, well, I guess after, you wouldn't check this box. But if you're writing for backup, you would check this box. If the property is a probate, there's also a probate advisory. If the seller holds title in the name of the trust, right? Which you're gonna know when you make an offer because you're gonna look up property records and you're gonna see that owner's name. If they own it in a trust, you need to attach a trust advisory. All right. 6 other terms. This is just a free form section where you can write in something that's not addressed on the contract or something you'd like to modify. I use section 6 often. If I can't fit everything on here that I need, I then instead use an addendum, okay? I want you to be extremely careful with using other term sections or addendums because it needs to make complete sense. It can't have any, subjective terminology. It has to be very clear. And as a newer agent, you might not always know everything you need to address. You might address one issue, but only the part that you're aware of. There might be other relevant conditions or things that need to be addressed when you're modifying something that's not in the contract. So make sure your mentor, an experienced agent, is looking at anything you modify or freeform right into a contract, okay? Allocation of costs. Section 7A1 is the natural hazard zone disclosure report. This cannot be waived. This is a state requirement, okay? So anyone, if you ever see, seller or buyer waives, or the buyer is trying to tell you to waive this, you used to be able to a long time ago. So if, a buyer is trying to tell you to do this, they might have done it in the past, but it is not allowed anymore. Under no circumstance can this be waived. Who pays for this? Almost always the seller. Okay, everything's negotiable in real estate, but this report is required for a seller disclosure. So on that note, oh shit.
What happened?
I accepted this offer and I didn't counter this out. Do you see this checkbox?
Yes.
So I need to make sure escrow caught that. I need to do 3 things. I'm glad I pulled this contract. I had to pull this contract up. It's like it was fate.
Where's that checkbox that you're talking about? I can't.
It says including tax.
Okay, there you go.
This is not common. I don't recommend asking for anything other than the natural hazard zone disclosure report, not because it's not good information. Most of this stuff is covered on the seller disclosures, but because of the process for the seller to obtain it. Typically, escrow orders the NHD or natural hazard zone disclosure report. So they order the NHD, but if you add any of these on, the seller has to order it, and it takes a long time and it's complicated and the seller doesn't understand. So this is going to be a problem for me because I can almost guarantee that escrow didn't catch it. I didn't catch it. It's just a pain in the butt.
So you're supposed to leave that alone, right?
Yeah, leave it alone. Do not write that into your contracts. So a lot of NHD company reps, they will come in and try to tell you that their company is better than other ones. I don't know if they're telling the truth or not. They always encourage buyer's agents to write their company in Please do not do that. The reason for that is because this is a seller disclosure. If you, the buyer's agent, are telling them what company to use and there's a problem, it is your liability now, right? You've shifted liability from the seller to yourself because this is a seller disclosure. So if you, the buyer, are saying, use this company to give me the information on this disclosure, and that information is wrong, the seller is not liable for it anymore. You stipulated what company. So please do not write the company in here, write seller's choice. Okay. Section 7A2, this should be blank. This should be blank most of the time. There's very rare exceptions in which this would be filled in. The agent who wrote this offer erroneously wrote 9A in here. 9A is the City of Los Angeles building report, which is required, but it's covered on the next page in this section here. Okay, so section 7A2 and 3 should be blank typically. I want to take the time to mention here that termite reports used to be mandatory in our escrows, mandatory. And it was mandatory that the seller paid for section 1 items of work. That is no longer the case. Now a buyer has a termite inspection as part of the inspection process. They pay for it themselves, which I highly recommend because that inspector is giving hopefully reliable, unbiased information to the buyer direct. Would you guys use a previous general inspection report that the seller obtained and take it as gold? No, right? Why would you do that with termite? So that was a problem. So buyers should now just get a termite inspection during the inspection contingency. It's like $99, they should have it. But I don't ever want to have any of you include the word termite anywhere in your contract. And if the other agent does, you need to immediately have them correct that, remove it, not just counter it out, remove it and resubmit whatever it was they're sending to you. The reason for that is because once a lender sees the word termite, whether or not this buyer and seller have indicated anyone should pay for anything, if they're aware that there's a termite report in existence, they will want to see it. They will refuse to lend unless they can see it. And if they see it and see things they don't like, they oftentimes will demand that the work is done prior to issuing loan docs. Why would the seller or buyer pay to have this work done prior to knowing the sale is going to close? They shouldn't, right? Also, maybe the seller doesn't have the ability to pay for that. Okay, so I never want to see the word termite in any of your documentation. Okay, even in the inspection negotiation process, if you're requesting a credit or want work done, I don't recommend having the termite work done as a condition of the escrow. I recommend having the buyer receive a credit and you don't identify that that is what the credit is for in the documentation that you provide to escrow and the lender. You can, disclose that in the email to the other agent that you're negotiating this credit with. Just know a lender never sees the word termite. Escrow never sees the word termite. Got it? Okay. And it was normal. Remember, so when you have a client that comes to you and they're like, what do you mean this person doesn't pay for termite or do it? You now know why. We changed the rules. It was primarily because since the seller was obligated to pay for this, what if they entered escrow? A seller does not have the ability to cancel, by the way, other than buyer non-performance. What if they find out that they need $50,000 in termite repair, but now they don't have enough money to pay off their loan through the closing, but the seller can't cancel? So what, now they have to borrow money, come out of pocket just to sell their home? Or what if it's no longer, doesn't make sense for them anymore? They still turn a profit, but not enough to purchase the house they were planning on purchasing or retire on like they were planning. So this is why we took termite out. So if you have clients who bought or sold in the past, I think this changed about 8 years ago. They might expect that the termite is going to be part of the contract and you'll have to educate them that it's no longer, and this is the reason why. Okay. Sorry, government requirement and retrofit. Government requirements and retrofit spans from B1 to 2. This includes the retrofitting requirements, also referred to as certificate of compliance, at least for the city of Los Angeles. Other cities also require a certificate, but not all of them. You'll need to check with the retrofitting company. And also any city building report. And this language in the beginning basically covers retrofitting. Retrofitting is a general term for bringing something up to safety standard, okay? There's earthquake retrofitting, there's water heater bracing, there's water retrofitting, there's a lot of types of retrofitting. But specifically, we're talking about city or state required retrofitting required to close an escrow here. Section 2, compliance with any other minimum mandatory government inspections and reports. So this is all very general language, and this section basically says the same thing, okay? It's written very broadly because it needs to work for the entire state, and every city has different requirements. So some, like, I think they recently changed this actually, but the city of Pasadena used to require that a city official went out and physically inspected the property to give a building report. Whereas the city of LA, it's just an application and you get the building report. But this covers all of it. So it's very broadly written. It kind of covers all the same stuff. The seller typically pays for all of these. Can the buyer pay for them? Yes, but they should not, because we don't know how much it's going to cost. It's going to be based on what is needed. Okay, so typically seller pays for this. Escrow and title. Very rarely will you ever see a deviation from this. Typically both boxes are checked, buyer and seller, and each to pay their own.
Yeah.
So each to pay their own as customary.
Yeah, it's easier.
Saren?
Oh, oh,
Hey guys?
she's talking to me. Hello?
Yeah, can you mute?
Sorry. Yes.
It's okay. Thanks. All right. So each to pay their own is customary. Section C1B, escrow holder shall be. Guys, if you're writing a buyer offer, what are you typically going to write in this section?
Seller's choice.
Yeah, why?
Don't
Does
know.
sellers like to use who they've been dealing with?
Yeah. They typically have more confidence in escrow that they're familiar with. Seller typically chooses escrow, but mostly because the market is ultra competitive and you just want your buyer's offer to get accepted. So trying to stipulate what escrow company or title company might hurt your chances of that. Okay, so seller's choice is typical. They wrote the escrow company in here because they asked me what escrow company I wanted. So they wrote my choice in here already. Now, the one exception might be, and you need to communicate this to the listing agent, is if your client is in multiple transactions or someone is out of area. And so, a buyer is more likely to need to go into escrow than a seller. So let's say my buyer is purchasing a property, but the seller lives in Palm Springs. So does the listing agent. Doesn't really matter where the property is. I might ask them, hey, can we please use a local escrow company because my client is elderly, might need to go into escrow, sign loan docs. So I'd like to use one here where they live. Or, they're selling a property. We already have that sale escrow over here. We don't need the funds to close, but it's just easier. They might do that. Section C2 is for the title company. Okay. Here, the seller pays for the owner's title insurance. Title policy to be issued by typically seller's choice. I want you to see here in the parentheses, buyer shall pay for any title insurance insuring buyer's lender. Didn't sellers say they're going to pay for the owner's title insurance policy? What is this about buyer paying for title insurance? Well, there's two different, there's more than two, but the two most typical title insurance policies are called the ALTA, Apple, Llama, Thomas, Apple, and CLTA, Cupid, Llama, Thomas, Apple. The ALTA policy is for the buyer's lender. If there's a loan, they will need title insurance. The CLTA is also referred to as the owner's policy that covers the seller. So typically we have two types of title policies. In the standard transaction, the seller pays for the owners and automatically the buyer pays for the lenders. Make sense, guys? Section D, other costs. Sorry, give me a second here. Other costs. So we'll go through these quickly. County and city transfer taxes are typically paid for by the seller. Okay, not all cities have transfer tax, but most do. There are some regional differences. So like a couple of the cities in South Bay, like Redondo Beach area, buyer and seller typically split just the city, not the county, just the city transfer taxes. Also, some places in Northern California, this is customary. I always write my offers unless I know for a fact otherwise that the seller shall pay for it. Even if it's customary for buyer and seller to split it, the listing agent could make a mistake and accept my offer. Anyhow, I save my buyer some money. Worst that can happen is I get a counter offer, and then I'm going to call an escrow company, usually at a KW office in that area, and verify that that is customary for the region. Section D3 through D7, these only apply if the property has an HOA. Okay, so condominiums, planned unit development, and the seller typically pays for all of those. Can the buyer? Yes, but I don't advise it. The reason that the seller typically pays is we don't know what those costs are going to be. All right.
I'm sorry, Kristen, I had one quick question.
Sure.
As far as the taxes and everything, I remember in one of the classes that they mentioned the supplemental income tax.
Mhm.
How is that relevant to this section?
The supplemental income tax. Yeah, I wasn't thrilled that they mentioned that in our previous class because it's not relevant to this section. When it is relevant is after the close of escrow, because that is when supplemental property tax bills come out. So what a supplemental property tax bill is sometimes after a closing, the county, because we know that they're super efficient, right? All city and county departments are very efficient. They're going to take longer to get the updated bill to the buyer than the next tax billing cycle.
Right.
Okay.
So how do you make sure that it's prorated in order to protect your buyer client's interest?
You simply have to tell them, the city, the county, they did not make a mistake. The assessor's office did not make a mistake. Your taxes should be this rate. And that will be quoted to them. Okay. So the lender will quote that to them. You can make them aware of it. As a good agent, you should make them aware of it. Is, hey, Mr. and Mrs. Buyer, you might get a lower than this amount tax bill your first 1 or 2 times. You did not get away with it. The assessor's office is going to send you what's called the supplemental bill for the difference. It's calculated based on the purchase price. So you might get a bill that's calculated on the previous owner's purchase price for the first bill.
Basically, up until the close of escrow, then, if I'm understanding correctly, up until the close of escrow, the escrow needs to deal with it as far as prorations. No?
Prorations for the current tax. Yes, it's 2 separate things. So the tax proration is because the way taxes are billed and then paid, right? So you might have a due date. There's an acronym, no darn fooling around. November, December, February, April. I believe it's due November 1st, delinquent if paid after December 10th. Don't quote me, it could be December 15th. It's been a while since I've been an escrow officer, but I believe it's December 10th. You could ask Pele, she would know for sure.
Okay, I just basically want to know that you want as the agent to protect your buyer client's interests. I don't want to digress too much. I just want to make sure that, as far as our liability as agents,
You don't have any liability there. Escrow is going to prorate that tax period.
Okay, thank you,
Yeah.
thank you.
Mm-hmm. The reason for that, I'll just close it up really briefly, is the taxes may be paid for a portion of time past the actual close date. So maybe the seller's basically prepaid. So there's going to be actually a debit from the buyer prorated and credited to the seller through the close of escrow, or it could be the opposite way, is that the escrow is going to close on a date of which contains the time frame for the billing period, but is not yet billed and will be billed to the new owner. So the buyer is going to pay for that period of time that the seller was in the property. We don't need to understand that. Escrow will handle it. Supplemental tax is entirely different. Yeah, that's going to happen after the close of escrow. You just tell your buyer, hey, listen to what your lender told you the tax is going to be. You didn't get away with any tricks. You're going to get a supplemental bill. You better save for it based on this figure, not on the actual bill you receive. Okay.
Thank you.
All right. Let's see here. Section D10 is the home warranty policy. All right. So the home warranty policy is tricky because you don't know how much it's going to cost, or at least you probably won't even have a decent idea until much further in your career, and you shouldn't guess. But as we all know, we often write offers in the evenings and on the weekends, times when home warranty reps might not be available. So home warranty reps would be able to give you a good estimation of costs here, and I'll tell you why it's important in a second. Some of the home warranty companies actually started putting estimators on their websites, which is very helpful. I know First American does. I don't know about the rest because I use First American. That's all I use. Doesn't mean that they're necessarily better or worse. I've used quite a few, but if I have a choice, I use First American. The only, I don't even remember the name of the company. There's one company I hate, but I don't remember the name of it. And they all cost around the same. So when you are writing this figure in here, it is based typically on square footage. All right. Condominiums typically have a home warranty policy between 450 and 700,000. Okay. It is important here that if you are guessing, you err on the side of being too high. Why? Because once this dollar amount is agreed to, if there is any overage, your buyer is going to have to pay for it, when typically the seller does. Okay. So a single family typically costs from about 650 to 1,000. Anything that's over 3,000 square feet can be higher. Income property can be exponentially higher. So please try to get this information from one of those websites or from a home warranty rep. Please try not to guess, but if you're going to guess, please guess on the high side, because if the buyer has to come in with money, guess who's probably going to be covering the difference? You. Don't go too crazy high, because then you're just going to get a counter offer, right? There's this fine balance there, but always err on the side of too high. All right, I always check upgraded. There's a little bit more policy coverage protection here, and it doesn't cost that much. It typically fits into the parameters of the estimations that we put in here. Okay. If there's an air conditioner, I always check air conditioner. If there's a pool or spa, I always check pool or spa. And this is not something most agents do. This agent did what I do here. He used different language, but I always check other, and I say buyer to determine during the course of escrow. The reason for that is no matter how large this allowance is in this section, a buyer can't have additional options added unless they are stipulated in the contract. So if I check other and I just say buyer to determine during the course of escrow, I don't have to identify which optional coverages they can have, but I do reserve their right to do so. Why is that important? I do it that way. Every home warranty company has tons of different types of policy coverage, and I don't know what they are. I'm not a home warranty rep. So by saying buyer to determine during the course of escrow, I can put that buyer in touch with the home warranty rep, and they can make that determination together, and I can stay out of that lane. Or buyer waives the purchase of a home warranty plan. So this is one of my favorite things to do if I'm in a very competitive offer situation. Why? Because home warranties don't cost that much money. And so I asked my buyer if they'd like to waive it to make their offer more attractive to the seller, in the hopes that we might get an acceptance versus a counter offer. I don't always do it in the offer. I might save that actually for the counter offer process, but it is something I do often. But you need to check this box here if the buyer waives it for any reason. I think it's important to note that if you're writing an offer on a new construction, it is not customary to ask for a buyer home warranty policy. Anyone have any idea why?
Because it
No?
already has.
Yeah, through
10
what?
years warranty, right? 10 years, I believe.
Not everything's 10 years. You have a complete, so it's called builder's new construction home warranty or warranty. And everything is covered for 1 year. And then depending upon what it is, and it's defined by, I think, California Civil Code, not by really, not by, there's no documents that we have that determine it. Depending on what it is that might have a defect, it might be covered for 1 year, it might be covered for 10, like Nagar said. It just depends on what it is. Again, not our lane. There are special attorneys that specialize just in builder home warranty law. So just wanted to make sure that you looked like the educated agent that you are if you write an offer on new construction. And you don't ask for a home warranty policy. All right, items included and excluded from sale. Let's see here. Sorry, I'm moving this little box around for your Zoom faces. Items included and excluded from sale. Anybody, can anyone tell me what the definition of what would automatically be included with property is?
Anything attached.
Or permanently affixed?
Permanent.
Better terminology?
Yes.
Fixtures.
Mhm. Exactly, good job. So it has some examples in here. Okay, existing electrical, mechanical, lighting, plumbing, and heating fixtures, ceiling fans, fireplace inserts, gas logs and grates. I'm not going to go through this, but I do think it's important to mention, it does say, because this is something that commonly we have a problem with, window coverings. Does this include drapes or not? We don't know, but there's a really easy solution to that, right? Anything that's gray area or like arbitrary, subjective, just identify it under section 3 or an addendum, make it extremely clear. Even if you think it's already covered under the law, just make it very clear. If you're a listing agent, you need to have this discussion with your seller too. They may be planning on taking light fixtures, window coverings, things like that. You need to make sure that you have that conversation. So if they want to, you can exclude it in the terms of the purchase agreement. And you can tell buyers and their agents about it ahead of time. By the way, just because you tell a buyer and or their agent that something's not included in the sale, just because it's disclosed on the MLS, that doesn't stand. It has to be in the purchase contract no matter what. Appliances, light fixtures, light fixtures would be included under the law, but it's just better to have that conversation and reiterate stuff than for someone to be disappointed at the end. When people are disappointed, you end up buying stuff. Okay, I don't like buying stuff that I didn't plan on buying for my client. If I have a crummy buyer, they're getting a bottle of champagne. If I have an amazing buyer, they're getting more. I want to be the person to make that determination. Okay, I don't want to have to go buy a washer dryer for someone because I made a mistake and I didn't ask and I didn't write it in the contract. Just be very clear. Sometimes I have to write an offer before I can see the property. I hate doing it, but sometimes I have to. So I wanted to point out, like if I'm asking for appliances, sometimes I'll make an offer, a blind offer is what I call it when I can't see the property. So I'll check all these boxes to be safe and I'll get a counter offer back or a phone call from the listing agent. We're not buying your client a refrigerator. And I tell them, no need. See here, it says only if it's existing. No need. Don't counter me, accept my offer. You like the rest of my offer, right? We don't need to counter because it says only if it's existing. All right, leased or liened items and systems. Sometimes there's stuff that's permanently affixed to a property that the seller does not own. Most common being what, guys?
Solar panels.
Yeah. So solar panels can be owned by the property owner, or they can be leased from a company. If it's leased from a company, The seller doesn't own that. So they're not able to transfer that with the property automatically. And so if that's the case, the lease needs to be either paid off by the seller through the close of escrow or assumed by the buyer. So the buyer's gonna need to see contract, no terms if they're gonna assume something, right? The seller probably needs to see a payoff statement. Escrow is definitely gonna need a payoff statement to pay it off through escrow and to record a reconveyance of the lien for the solar panel lease through the close of escrow. Title's gonna wanna see that, the lender's gonna wanna see that. And it can get tricky. It can take some time. So if you see solar panels or any of the other items that are listed on here, and they're most commonly like water softeners. If you're dealing with multifamily property, sometimes there'll be things like community washer dryers in the community laundry room that are not owned. Just ask the listing agent or property owner and get that worked out. So I actually did one fairly recently that had a leased solar panel, and it held our close up by like 5 days. Because even though we requested everything we needed, the lender came back to us at the end and said, oh, we want this additional language in the payoff statement from the lender, and, you know, or not the lender, from the solar panel company. So, you know, just be ahead of the curve on those things. And also remember that this is a contingency of the sale, leased or lien items. Seller shall, within the time specified in paragraph 14A, 14A is seller disclosure contingency, disclose to the buyer if something is leased or not owned, and deliver all written materials such as lease, warranty concerning any such item. Well, if 14A, the seller disclosure contingency, is long, you don't know that till day 7 of escrow. You may already have a problem because they might take some time to get the documents you need from that company. So just be really aware of those things. Items excluded from sale. So, you know, if the seller is going to take those chandeliers, everyone agrees to that, it needs to be written in here, like I said. Then there's this funny little section that got added a few years ago. I don't like either option here. So our boilerplate says that brackets or components shall remain with the property, and that means like screws, nails, that kind of thing, brackets. It says that they shall remain with the property, okay? Or they'll be taken out and patched, but not painted. I don't like either of those options. Do I typically modify this? No. But I've had an instance where there was like an art gallery wall and a custom paint job behind it that was beautiful and would be difficult, if not impossible to replicate. So what I did was I modified this language on an addendum, and I said that both should be done, that everything should be removed and that it should also be patched, but also painted. Okay. Closing and possession. Buyer either intends or does not intend to occupy the property as the buyer's primary residence. Do buyers always answer that question honestly?
No,
Why is that?
because it affects their mortgage rate.
Yeah, it affects their mortgage rate. So to keep myself out of trouble, if I'm not certain about this or how it should be filled out, I generally ask the buyer, how should I fill out this section? How should I fill out this section? How would you like me to fill out this section? Instead of asking them and then lying, because that's on me ethically, right? How should I complete this section? Don't tell me, just tell me how, and don't tell me what you're doing, just tell me how I should complete this section. Right? Section 9B, highly contested. People think or assume a lot of times, and it used to be a little bit more industry customary, that upon confirmation of recording, which is what happens on the day of the close of escrow, where the grant deed is recorded, transferring the title of the property from the seller to the buyer, now new owner. So that can happen anytime between 9 and 5. The title company would let you know when confirmation actually occurs. So technically the buyer is the owner of the property at this time. And so people assume that keys and possession is to be delivered to the buyer at that time. Unless that is not the case. Our contract says that possession is to be delivered to the buyer at 6 p.m. on the date of close. So unless you modify this, which I don't recommend doing prior to 5 p.m. And why is that? We might not actually have confirmation of acceptance. It might not have happened. So don't recommend doing before 5 p.m. But unless you modify it, it is automatically 6 p.m. If you're going to have a very, very small delay in delivery of possession, and there is no monetary consideration provided to the buyer from the seller, you can use this section to indicate that the seller is going to stay in the property for 1, 2, 3 days. I probably would not use this section for anything longer than about 5 days, guys. That's just my comfort level for my own liability. 1 second, sorry. Hi. What's up? That might be slightly problematic for me. I can be there probably in 40 minutes. Okay, thank you. Okay, bye. Sorry about that, guys. Where were we? Oh, so delayed delivery and possession. If it's just a few days, I can use this section. If there's also no monetary compensation provided to the buyer by the seller for that delayed possession transfer. If there is going to be monetary consideration and it's longer than about 5 days, I have to either use, or I have to use section C, and I have 2 options there. I can use car form SIP, which stands for seller to remain in possession. It goes over all the financial terms. It's a fantastic form, very easy to fill out, very clear. That covers pretty much everything that needs to be covered. But car form SIP can only be used if the seller is going to remain in the property, whether or not there's compensation, for fewer than 30 days. If they are going to be in the property longer than 30 days, car form RLAS, residential lease after sale, needs to be used. Buyer agent beware. Lenders typically do not want to see a lease back. This all is also referred to as a lease back, by the way, the general term for it, which I don't like, of over 45 days. Some of them 30, some 45. So if a seller is asking for longer than 30 days, you want to check with the buyer's lender before you agree to that. Okay. Can be done with or without compensation. The most typical type of compensation provided to the buyer is what, guys? PITI, the buyer's actual carrying costs, ownership costs. PITI stands for principal, interest, taxes, and insurance. But there's a caveat. You might also want to include prorated HOA dues if there's an HOA. Okay. Tenant occupied property. So the most common type of tenant occupied property is going to be multifamily. There's a different purchase contract for that, guys. This is only for condos and single families, this contract. That contract is very similar, but it is different. So it's rarer that there's a tenant occupying a single family or condo, but it does happen. And a term of the sale could be that the property is going to be delivered vacant, but the buyer may be purchasing it with the tenant in place to keep the tenant there. If that's going to be, if that's not going to be the case and they want it vacant, you can stipulate how many days the property should be vacant for prior to the close of escrow. And our contract says 5, but I find that because we have very aggressive rent control in our area, I find that to be way too short of a time frame. So if we have property that's tenant occupied, that's supposed to be delivered vacant, I typically want to see it vacant for at least 10 days prior to close of escrow. Why? I don't want my buyer to sign loan docs and do all that garbage if it's not actually, if the tenant's not actually going to leave. Also, the tenant could be upset and damage the property. I want to give the seller enough time to repair it before close of escrow. I also am typically asking for a very long escrow period because if someone's getting rid of a tenant, which by the way is not possible during COVID, guys, they've extended a moratorium on that through June 30th. But depending on how long the tenant has lived there, it may be 30 days notice that the owner needs to provide to get rid of the tenant, and maybe 60. So if it's going to be a 60-day notice or a 30, first off, I'm going to ask the listing agent. I definitely need an escrow as long as it takes for the notice, but also probably whatever amount of days I wrote in here. So if they need to give a 60-day notice to the tenants and they haven't done it yet, and I definitely want to see it vacant for at least 10 days, how long do I need for an escrow?
70.
Yeah. And I have to explain that to the listing agent because they're going to look at my offer and be like, what is this 70-day escrow? Because if they don't already know, they're going to be a dumb agent. So I'm really going to have to explain it to them to get my offer accepted. All right. Or the tenant's going to stay in the property. You would check this box and do a tenant to remain in possession form, TIP. All right. I'm not going to read through these sections. I'm only going to read through the sections that we need to modify and that we need to discuss with our clients, but you should absolutely read through all of these sections. Something that I think is worth discussing is all contracts, guys, are written in as is, okay? A condition of a contract, boilerplate language is as is. So when I get a counter offer back and my buyer's freaking out, but it says as is, I point this out to them and I say, who cares? All contracts are as is. It doesn't keep us from having the right to ask if we want. And there is motivation for the seller to negotiate with us versus canceling on us, no matter what they say, because all contracts are as is. Okay. Buyer investigation of property and matters affecting property. So this talks about liabilities and responsibilities during the inspection process, like the seller making the property available for inspection, the buyer being responsible for damage or injury occurring during inspections, things like that. I will discuss that in great detail in inspection negotiation class. But I do want you to be aware of those couple of things. I think this section 12 is really empowering. I highly encourage that you read it. All right. Arguably, besides the financial terms, the most important section of the RPA, section 14. Section 14A has to do with the seller disclosure contingency. 14B has to do with the buyer investigation contingency. Okay, so 14B is erroneously referred to almost always as the buyer's physical inspection contingency. Physical inspection is just a portion of the buyer investigation contingency. Okay, just a small portion. So let's talk about 14A first. Seller disclosure contingency. This is the time frame in which the seller has to give all the information to the buyer. And even though most people don't enforce this, I want you to understand how inclusive that is. That's everything. That's the building report. That's the certificate of compliance. Technically, I'm out of compliance on this deal right now because I haven't done the retrofitting and given the certificate to the buyer's agent. Okay. Like I said, most people don't enforce this, but if push comes to shove and there's a problem, if you have an educated buyer's agent who needs to dick you around, get some more time, cancel for some reason, they're going to hit someone like me who hasn't done the retrofitting certification yet and say, hey, Kristen, my buyers are not lifting this contingency, or they need more time. And I'm going to say, fly a kite, lift your contingency. I may even think about serving a notice to perform, but I can't really do that because I haven't given them everything that they need. The second I give them that certificate of compliance, if this time frame has passed, they have 5 additional days to review and cancel for any reason. Okay. So it's really important. That's covered here. So it says if by the time specified in 14A, the seller hasn't given anything, the seller hasn't given something to the buyer, so something's delivered to the buyer after the seller disclosure contingency is expired, then the buyer has 5 additional days after the delivery to review and either issue the removal of the contingency or cancel the agreement. Very powerful. Cancellation, huh? Very powerful.
I have a question.
Mhm.
So would you, in this competitive market, also modify both A and B from 7 to 5 and 17 to 10? That's the first question. Would you?
I'll talk about that, possibly.
Okay.
Yes, I would almost always shorten these, but it's gonna depend upon some of the variables, how much I would shorten it.
Okay, and then also, is this for the 14A for the seller? Does that also include the SPQ?
Oh, yeah.
Okay,
SPQ, TDS,
All of them,
NHD, all of them, everything, HOA documents. That's another one that's hard out of our control that oftentimes is delivered after this date range has expired. So strategically, as the buyer's agent, I love shortening 14A. Why? I can build in some automatic dickish protection. I'm being a total dick if I invoke this, you know, for a reason other than actually needing these reports. I'm usually invoking this because something's wrong with my buyer or my buyer's loan, right? So it's a total dick move by me, but I do it if I need to. So I like to shorten it there because it's more likely they're going to deliver me something late. So if I write 5 days in here, I could end up with 10 or more. Whereas if I wrote 7 in here, I might not end up with 10. So by shortening it, I could end up with more time if I need it. But also there's a second reason. I like to review the seller disclosure package before my buyer's inspections take place. Because if there's anything disclosed on there, I want to be able to tell the buyer's inspector, hey, this might be a concern. Can you please take a very close look at this? All right. 14B, buyer and guys, so I typically wouldn't ask for the seller disclosure period to be anything less than 5 days. Why? I think I would probably get a counter offer in that case. Okay. Or I think that might get countered, that term might get countered because that's a pretty aggressive time frame. Most listing agents are just thinking about the seller disclosures. They're not thinking about these other little loopholes I'm telling you about. So yeah, try it 5. Anything more than that, you're probably never not going to get it past them. 14B. So the buyer investigation period, which people always just assume they call it the physical, like it's interchangeable. It's not. Physical is only, like I said, a portion of the investigation period. For a condo, I think the most aggressive you can get on here is 7 days, and that's tough. You might have to use second choice, third choice inspectors, and you're going to have to rush, and the buyer's going to have to be available whenever the inspector's available. But on a condo, I wouldn't say to write more than 10. That would be considered not very competitive. On a single family, the shortest I would ever go is 10. And because the market's really competitive now, maybe 14. If it's a very large home or an estate home, maybe 17. Okay. I don't ever go longer than 17 days. And that's, like I said, only on a very large home, or if someone's going out of town and I kind of pre-negotiate these terms. Okay, so, you know, I keep on telling you, this is not just physical. So let's talk about that. Let's read that. Buyer investigations, which includes reviewing all the disclosures, all the reports, any lease documents, any tenant related documents, anything to be assumed by the buyer, including like that solar lease, if there was one, or other applicable information. Okay, so it's not just a physical, and actually in our contingency removal document, it breaks these out. Title report, insurability, buyer physical physical investigation. Okay, so there, it can be broken out. You can lift part of 14B. Okay, again, this is very technical and it's kind of a dickish move, but you can buy more time because if you don't have one of the reports you need, you can kind of garner some goodwill by lifting part of 14B, but not all of it. And if you're not lifting all of it, it's still in place, right? You still have all the protection. So it's a good way to kind of dangle a non-committal carrot. Let's see. C, removal of contingencies with offer. If you're going to lift any contingencies with the offer, you should indicate that here. It will populate a contingency removal form. Powerful tool when you're submitting offers. So if I have an all cash offer, even though I have no loan contingency automatically, I love to check this box anyways and have a visual contingency removal form and put that right on top in my offer package. So we're talking about all these contingencies. What happens if a buyer doesn't lift their contingency on time? Well, you can either be granted an extension that's negotiated between the buyer and seller and their agents, or the seller can choose to do nothing and just ride with you, which happens oftentimes. You know, it's generally based on comfort level and the circumstance of the escrow, or the seller and their agent can issue what's called a notice to perform. A notice to perform gives a buyer notice 2 days to either lift that contingency, or the seller technically has the right to initiate cancellation. I'm not going to go into why I said technically. Cancellation is a lot more complicated than that. Now, I want you to be aware also that this notice to perform, it can be delivered preemptively. What do I mean by that is, let's say a physical inspection, the buyer's investigation contingency expires on the 10th of the month. The listing agent, this is very, very aggressive, but the listing agent could technically deliver a notice to perform on the 8th. Okay. So you can preemptively be served with a notice to perform to enforce the contractual deadline that's already negotiated. Most agents wait until the actual contingency deadline date pops up to issue one of those. And even after that, you know, it's a very bold move, and it can cause sour relations and cancellation when things could still be worked out. So I want you to be aware of what they are. We do have to confirm receipt of these. I want you to be aware of what they are, how they can be delivered, how they can be used. And it's a situational thing. It's not something I highly recommend using. It's very, very situational. Okay. There's something very similar to that. It's when all the contingencies have been removed, but the buyer has not yet closed escrow. This is called a demand to close escrow. It's almost exactly the same as notice to perform, only instead of being 2 days, the buyer has 3 days. Okay. Final verification of condition, also referred to as the final walkthrough. So the way our contract is written is within the 5 days prior to closing of escrow, the buyer needs to do a final walkthrough of the property to verify that it's in the same condition as the time they made the offer, and that if any repairs were agreed to, they've been made. Now, I do want you to notice that it's not as a contingency of the sale. The buyer doesn't actually have the right to hold up closing the escrow, but I highly recommend doing this final walkthrough 5 days ahead of time, so that if there are any problems, you guys will see them and give the seller the opportunity to correct them, so that it's not some sort of lawsuit dragging on after the close of escrow. By the way, it's not that common for us to have problems. The most common issue for condition of property is that something hasn't been cleaned, or not all debris has been removed from a property, you know, prior to close as it's supposed to be. Let's see here. Remember, I told you if seller was an entity or buyer was an entity, that's called representative capacity. Okay. And when we have an entity, buyer or seller, we need an additional form. It's called the RCSD, and there are 2 versions. One is -B for buyer, or -S for seller. So if you're writing the offer, way down here, you check this, you have to check this box if your buyer is an entity, and that form will auto-populate. Okay. Sorry, we are here. Okay, again, I'm not going to go through all this, but do read it. It's very valuable for you. Section 21 and 22. This is liquidated damages arbitration. Typically, buyers and sellers initial this. It is not required that they do so, however, in order to accept a contract. I honestly don't understand anything about either of these, and I hope I never have to, because the only time this is an issue is when you've got a big problem on your hands And at that point, it's going to be Michael Rosales and our attorney, our team of attorneys helping us out. I hope you never have to know much about it either. Okay, so there's a lot of definitions here. Again, read it, very valuable. Section 31, expiration of offer. Okay, a couple things to note here. Oh, you're welcome, Justin. Expiration of offer. Okay, so big mistake I see often. If you're the agent, put your name in here in this check, in this blank right here. Okay. People ask me all the time, should I put an expiration on my offer? I don't think so. Why? A seller is going to respond to a buyer when they want to. And if the buyer is still interested, they're going to respond and or accept or counter at that time. The only time I might put an expiration of offer in here is if I have an inexperienced listing agent and I'm trying to manipulate the situation. Or I have kind of pre-negotiated with the listing agent because I'm going to make a way higher than asking offer with really aggressive terms. I don't want my offer shopped and I'm like, look, I'm going to write you this great offer. You told me everything you want. I've got it or more, but I'm going to give you guys 2 hours to accept it because I don't want the offer shopped around. Another big mistake I see on the contract is we don't have the occasion to enter the seller's name except for on some of the disclosures or this page of the contract. Okay, so make sure you include the seller's name on the contract. Back in the day, it used to be up at the top of page 1. It isn't anymore. So oftentimes, by the time you get down here, you think you're pretty much done and you might not have the seller's name in here. So make sure you have it. Okay. Here, make sure you have the complete information for both agents. It's going to be important in case your offer is accepted or countered. And another thing to keep in mind is the buyer needs to initial the bottom of this page before you submit the offer. Because this page doesn't have any section for the buyer, it is commonly missed. But the buyer has to sign every page of the offer, right? So make sure they initial here. Attached is also the buyer inspection advisory. Again, read it. Nothing for us to complete. Consumer Privacy Act advisory. Nothing for us to complete, but you should read it. That's pretty much it, guys. I'm really tired now, but I'm happy to answer any questions you have before I go.
Thank you, Kristen.
Yeah, you're welcome.
Sorry, Kristen, I only have one question.
Yeah.
Under which section is it that, like, let's say the buyer decides to give 2 offers on 2 different properties just because it's so competitive right now. Under what section of the contract can the buyer back out for any reason in the beginning?
14B.
14B. Yeah, okay. That's all I wanted to know. Thank you so much, as always. You are so
You're
amazing.
welcome. Thank you.
Thank you.
We have a question in the chat box asking if the buyer or seller can e-sign or do they have to physically sign. 100% we can electronically sign. The only thing that cannot be electronically signed, guys, is something that needs to be notarized or a document that only the buyer fills out in an escrow. Well, that's not true. Sometimes the seller fills it out too, called a preliminary change of ownership report. But we typically do not handle these things, escrow does. So most of our stuff, anything we issue can be signed electronically.
And you said that if a seller or buyer is an entity, we just put the name of the entity, but they sign obviously their own. It's just a little tricky.
Yeah, they sign their own name.
When it's a trust or entity. Okay.
Yeah, under
Okay,
seller, you
corporation.
put the name of the trust in there, but the signature line, like I have a trust, right? So under seller or buyer, whatever I'm doing, it's going to say Kristen Toll Trust dated blah, 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 but I'm signing Kristen Toll. I could have a trust called Yellow Bag Trust.
Right.
I'm still signing Kristen Toll on the signature line. Yeah.
Okay, thank you. Thank you.
Mhm. Anyone else? No? Okay, then. I'm going to get
Thank
going.
you. Thank you.
Bye-bye.
Thank you.
Thank you so
Bye,
much.
guys. You're welcome.
Bye-bye.
Welcome. Take care. Bye.